Hello and welcome back to Money Never Sleeps. My name is Timur from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. There's a strategy that's been generating a lot of conversation in the retirement planning world lately, and it's called a Roth conversion. You may have heard the term. You may have even been told by a friend or colleague that it's something you should look into. And it's true that for some people, a Roth conversion could be a really powerful tool. But here's the thing, what works well for one household can cause real financial strain for another. This isn't a one-size-fits-all strategy, and today I want to give you my perspective on what a Roth conversion actually is, who it may benefit, and just as importantly, who it may not be right for. Today's conversation is based on a recent Kiplinger article that's headlined, "Should You Jump on the Roth Conversion Bandwagon?" Let's walk through the key ideas. At its core, a Roth conversion means moving money from a traditional IRA or 401k into a Roth IRA. When you make that move, you pay income taxes on the amount you convert today. In exchange, that money may grow tax-free, and qualified withdrawals in retirement could be tax-free as well. You can see why that's appealing, especially when a lot of people are concerned about where tax rates might be headed in the years to come. If you believe taxes are going up in the future, paying at today's current rates starts to look pretty attractive. There's also something else that draws people to Roth accounts, and that's the issue of required minimum distributions, or RMDs. Traditional IRAs and 401ks require you to start taking withdrawals at age 73, whether you need the money or not. And those withdrawals are taxable as ordinary income. Roth IRAs don't have that requirement during the account owner's lifetime. That may give retirees more control over their taxable income in retirement, and that control can be valuable when you're trying to manage what tax bracket you fall into each year. For someone who has other income sources and doesn't necessarily need to tap those retirement funds right away, the ability to let that money continue to grow without being forced to pull it out on a schedule can be a real advantage. There's a legacy planning angle worth mentioning too. Roth IRAs can be an effective tool for passing wealth to heirs, since beneficiaries may receive tax-free withdrawals under certain conditions. For people who want to leave something behind without handing their loved ones a significant tax burden, that can be an important part of the conversation. So who tends to be a good candidate? There are a few situations where the case for a conversion could be stronger. One is someone who's in a temporary lower income period. Maybe you've just retired but haven't started Social Security yet. Maybe you had a year where your income was lower than usual. That window, where your taxable income is below where it normally would be, could be an opportunity to convert some funds at a more favorable tax rate. Another situation is someone who has built up a very large balance in tax-deferred accounts. Here's why that matters. When RMDs kick in at age 73, those required withdrawals could be quite significant depending on the account size, and every dollar that comes out is taxable. If someone has accumulated a large tax-deferred balance over their working years, they may find themselves pushed into a higher tax bracket in their 70s and beyond, whether they need that income or not. Doing some strategic converting earlier, while income is lower, could help manage that future tax exposure. But before you get too far down that road, there are some real things to think through carefully. I think the first question to ask yourself is, what does your tax situation look like right now compared to what you expect it to look like in the future? Because the whole premise of a Roth conversion is that you're paying taxes now to potentially avoid higher taxes later. If your current tax rate is actually higher than what you'd expect to pay in retirement, the math may not work in your favor. There are also ripple effects to consider that people frequently overlook. When you do a Roth conversion, you're increasing your taxable income for that year. That increase could affect how much of your Social Security benefit is taxable, or it could push you above income thresholds that trigger higher Medicare premium surcharges, called Income-Related Monthly Adjustment Amount, IRMA surcharges. There's also a required holding period to be aware of. Converted funds generally need to remain in the Roth for at least 5 years before withdrawals are considered qualified and tax-free, so if you're converting with the expectation of needing that money soon, the timeline may not work in your favor. A conversion that looks attractive on the surface could have unintended costs if it pushes your income across one of those tax brackets thresholds. There's also the question of how you pay the tax bill. One potential strategy is to pay the taxes on a Roth conversion should be paid using funds outside of the retirement account itself, such as cash savings or a taxable brokerage account. If you use money from the retirement account to cover the tax bill, you're reducing the amount that actually ends up in the Roth, and that could shrink the long-term benefit of the entire strategy. For some people, the most effective approach to a Roth conversion is to do it gradually rather than all at once. Rather than converting a large balance in a single year, which could push you into a significantly higher tax bracket, some people convert smaller amounts over several years. I think this can give you more control. You can convert up to the top of a certain tax bracket each year and adjust as things change. Tax laws can change. Your income can change. Your needs can change. A phased approach could give you the flexibility to respond to all of that. One of the common misconceptions is that a Roth conversion automatically leads to lower taxes overall. People hear about the tax-free withdrawals and assume the benefit is a given. But whether a conversion actually saves you money in the long run depends on your future tax rates, your spending needs in retirement, how long those assets stay invested, and a whole range of factors that are different for every household. For example, a teacher retiring at 62 with a pension looks nothing like a business owner selling their practice at 55. Time horizon is probably the most underestimated factor in my experience. Roth conversions tend to work best when there's enough time for that tax-free growth to offset the upfront tax cost. If someone is in their mid to late 70s and expects to need those funds relatively soon, the numbers may simply not work in their favor. You need time for the strategy to pay off. And just because a neighbor or colleague did a Roth conversion and had a great experience doesn't mean the same result is waiting for you. Every household is different. Income levels, account sizes, time horizons, estate planning goals, and spending needs in retirement are all factors. What's the right move for one person could be the wrong move for another. Married couples may also want to think beyond just the appeal of leaving tax-free assets to heirs and consider the annual cash flow required to support ongoing conversions. If you're converting meaningful amounts each year, you're probably also generating a tax bill each year. Without adequate planning around that cash flow, even a well-intentioned strategy can strain household finances. The bottom line is this: Roth conversions can be a powerful part of a retirement strategy, but they're a tool, not a universal solution. But I think the decision should be based on a careful look at your current income, your future tax expectations, your available liquidity, your time horizon, and your long-term goals. Working with a financial services professional and a tax professional before making any final decisions is strongly encouraged. The pieces can interact in ways that aren't always obvious, and getting personalized guidance could make a difference in whether the strategy actually works in your situation. But general information is just a starting point. A personalized strategy is the destination. And the distance between those two things is where the real work of retirement planning happens. If you have any questions about retirement or your financial strategy or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.